about his book, Smart Money, A Psychologist's Guide to Overcoming Self-Defeating Patterns in Stock Market Investing. A little bit about Stanley. He's appeared on more than 50 national television and radio shows, including Nightline with Ted Koppel, Good Morning America with Charles Gibson, 2020, and Court TV with Nancy Grace. Dr. Teitelbaum earned a BA in psychology from Brooklyn College, an MA in psychology from Boston University, and a PhD in clinical psychology from Boston University. In his spare time, he's a devoted tennis player and has won several trophies. Thank you so much, Stanley, for being with us here today. I just want to mention before he gets started, if you have any questions for him, you can put them in the chat and I will read them at the end. Or if you wanted to hold on to your questions until the end, you can unmute yourself and ask them yourself. Otherwise, thank you again, Stanley, for being here with us, and feel free to get started.
Yeah, thank you. Thank you for introducing me. Thank you, folks, for tuning in. And today is really a very harsh day in the stock market. So I think my book, Smart Money, A Psychologist's Guide for Overcoming Self-Defeating Patterns in Stock Market Investing, is very apt. In the current bear market environment, how do you react to negative or bad investing news? Many of you probably avoid looking at your brokerage accounts, your brokerage statements. You're looking less at CNBC than you usually do. And it's a natural tendency for you to not want to see the bad news. So you avoid facing it. You want to avoid the emotional pain. Studies suggest that the pain of a loss is 2.5 times as great as the joy of a gain or a win. And there is an analogy in the world of sports. For example, in football, Tom Brady, in basketball, Jerry West have said the same thing, that losing is more painful than winning. My goal tonight is to discuss some of the basic principles for overcoming your self-defeating patterns and your self-defeating investing decisions as described in my book, which would create a better pathway for success in stock market investing. As one of the people who kindly provided a blurb on the back cover of my book has said, as you listen to some of Stan Teitelbaum's examples, you will identify with them and you will say to yourself, that's me, okay? I hope that happens for you. I'd like to start with a couple of nuggets for you about some of the savvy investors here may be very familiar with, and some of the less experienced investors might appreciate. The first one is called sell in May and go away. Sell in May and go away. And the reason that that expression has received a lot of attention is because the 6 months of the calendar year between May through October historically tends to be the less productive period in stock market investing. So for people who listened to that saying, sell in May and go away, they're probably very happy with themselves right now because it's been a very, very difficult period of time since May. And April in particular was a very, very bad month. It was the worst month actually since 1970 in terms of how well the stock market did as measured by the Dow Jones Industrial Average or the S&P 500 index. The second nugget is to think about which are the best months and what are the worst months for the stock market. And the worst month is, as you can probably guess, the worst month is September, which is what's happening this year for sure, and has happened in many other Septembers. But this is about probability. It doesn't happen that way all the time. And all of this is about what is more probable or less probable. So September many years, actually since 1926, has been the worst month of the year. And the best months of the year have been December, July, and April. Again, it's about probability. So this year, April was not among one of the best months. My background is as a clinical psychologist and a psychoanalyst, which is what I've been doing professionally for many years. And people ask me, well, why did you write this book? And the three things that come to mind are that in the course of my experience as a psychoanalyst, I've had the opportunity to work with many people who have had self-defeating patterns in their personal relationships. And that's something that we've worked on, hopefully, to make them more successful in dealing with their personal relationships. The second factor is my own checkered track record in stock market investing. And so I'm going to tell you a lot about that, but that's a second factor in what prompted me to write the book. And so the book partly is a memoir. The third factor is that when I did some research, I discovered that since 1926, the average annual gain in the stock market, again, as measured by the Dow Jones Industrial Average or the S&P 500 index, has been 9.6%. That is almost 10% average annual gain. Now, that is terrific. That tells us that there is an upward tilt in stock market investing, and it leaves much room for error. However, the gains are significantly less for the average investor. So there have been studies that indicate that although the average annual gain for the overall market is 10%, close to 10%, for the average investor, it's as much as 7 percentage points less, like 3%. So why? I ask myself, why? How did this happen? Why does this happen? And the answer is because of all the ways in which investors shoot themselves in the foot and get in their own way in terms of how they manage their investments. Benjamin Graham, who is considered to be the father of value investing, wrote this classic book back in 1949 called The Intelligent Investor, and it has remained a classic through many editions ever since. And what Benjamin Graham said in The Intelligent Investor said, the investor's chief problem and even his worst enemy is likely to be himself. Incidentally, the 9.6 average annual gain that I mentioned is seldom between 9 and 11% in any given year. In other words, it overshoots or undershoots the average in what I refer to as the miss the market rubber band effect. It overshoots the 9 to 11% range or undershoots the 9 to 11% range. So there's a lot of volatility in what happens with the average annual gain. So what contributes to our investing blind spots, our errors in judgment, which leads to portfolio underperformance? And what I've come to put together and think about is that among the four most common problems in stock market investing are: 1, buying high and selling low; 2, the herding instinct; 3, looking for the guru; and 4, staying too long with an unproductive financial advisor. Up to 90%, it's been noted in studies, that up to 90% of financial decisions are driven by emotional influences. What are some of these emotional influences? Greed, fear, euphoria, which is an extension of greed, despair, which is an extension of fear, overconfidence, and regret. Regret is very interesting because since my book came out, I've had the opportunity to have podcast interviews around the world. And I was also interviewed by barons. And in one of the podcast interviews, the host picked up on regret. He said, you know, regret is not often written about or talked about in terms of stock market investing. And he said, let me tell you a personal story, which is many years ago, I had invested in this oil company and I held it and it did nothing. It did absolutely nothing. And then it even went down and then it continued to go down, but I continued to hold it because I didn't want to have to deal with the regret. And so finally, at some point, more recently, he said, I had the courage to cut my loss and to sell it. And so he sold it. And then it went up. So he felt shame. What he felt was shame. Shame had having made such a foolish investment. And then what we call double shame, because not only did he have shame about making a mistake or what he thought was a bad investment, but then also for then selling it and then to see that it rose after he sold it. So that's a case of double shame. So shame, regret can lead to feelings of shame, right? And shame then introduces his inner critic. He was very critical of himself for being so foolish to make that investment and then to sell it when he did, which was very, very poor timing. Let's go back to the common self-defeating problems in stock market investing. Let's talk a little bit more about buying high and selling low. All too often, we respond to huge price swings by being lured into buying at the top and panic selling at the bottom. In a bull market, a rising tide tends to lift all boats, and we chase hot stocks or mutual funds. But chasing hot stocks or funds becomes a recipe for getting burned as prices boil to unrealistic highs, and then they fall back. A declining market can be vicious, and as things get progressively worse, we become susceptible to feelings of terror, like today when the stock market went down so much to a new low for the year in this bear market as our portfolio shrinks. We can't stand it anymore and are prone to panic selling, which often then is at or close to the bottom. John Bogle, who is the founder of Vanguard Funds, is quoted as having said, when there is a gap between illusion and reality, it is only a matter of time until reality prevails. So it's one of the mantras that I subscribe to that's really important in being more successful rather than less successful is discipline, 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 discipline. And discipline means resisting getting swept up in the mania of a bull market and in the terror of a bear market. Okay, the second principle has to do with the herding instinct. The herding instinct is described as a group contagion effect, which pulls us to follow the crowd. If everyone else is buying stock XYZ, it must be a winner. So I want to jump in on the bandwagon and buy it too. This is known as Fomo, F-O-M-O, FOMO, fear of missing out. It's an emotional reaction. FOMO is an emotional reaction that pushes people to invest in a less disciplined way. The fear of missing out can be overpowering, but resisting FOMO is vital to good investing behavior. The problem is that too often the average investor comes late to the party and gets burned in the process of his late in the game decision. A second component in the herding instinct and in FOMO is that it enables the investor to avoid or circumvent the emotional consequences of making a wrong decision. So investing with the crowd makes you feel safer. The third problem is what I call looking for the investing guru, seeking an expert who we designate as our financial hero and who we place on a guru pedestal. Psychologically, everyone yearns for the magical roadmap that will enhance their wealth. For example, in an interesting story, Barbara Streisand once described how she made a profit of $130,000 in her stock market investing in 1 month, $130,000 in 1 month. And she told this to her friend, the fashion designer, Donna Karan, who jumped on it. And Donna Karan said to Barbara Streisand, "Wow, you must be great at this. I want you to be my investing maven." And so Donna Karan gave Barbara Streisand $100,000. I'm sorry, gave her $1 million, gave Barbara Streisand $1 million to invest for her. And over the course of several months, I think it was about 5 months, her $1 million then increased under the tutelage of Barbara Streisand's guidance to $1.8 million. So, as I said, psychologically, a part of us longs to connect with an authority figure who will look out for our best interest. Now, here are a couple of examples of how people might go in the wrong direction on this. For example, David Lerner Associates, a brokerage firm which thrived on selling investment products to seniors, markets a promotional video that says, quote, "The most important message is that we always put the client's interest above all else. It has to be you first, and we have to do things that are in your best interest." Well, Lerner ran into trouble with the Federal Industry Regulatory Authority, known as FINRA, for misleading investors. And TIAA-CREF, which is also very popular, and built their reputation on always putting their client interest first, was accused by a group of employees in a lawsuit which alleged that the company pressured them to use shady sales tactics. So here's an example of looking for the investing guru. And some of these four problems that I'm mentioning, they kind of are overlapping. But what comes to mind to me in this context is that what happened with the Bernie Madoff scandal. And many people yearned to be a privileged member of his club, to be a member, to have your investments managed by Bernie Madoff was a badge of courage. So people wanted that. People yearned to have that. Everyone wanted to be a client of Bernie Madoff until what happened. So what I want to share with you is that I have a friend who was my closest friend all the way back in elementary school, growing up in Brooklyn. And we have a tradition in which every year on his birthday, I take him out to lunch, and on my birthday, he takes me out to lunch. So at one of these lunches about 10 years ago, he confided in me that he had been a victim of the Bernie Madoff scandal, that he had lost a lot of money through his investments in Bernie Madoff. And so my reaction to him was sympathetic and empathetic. I really feel badly for you for what happened there. But then my second reaction was to say to him, I'm disappointed. How come you didn't refer me to Bernie Madoff. I would have at that time liked to have been one of his clients. And he looked right back at me and he said, well, you know what, Stan, the reason I didn't refer you is because I didn't think you had enough money that he would have taken you. So he wouldn't have taken you. So that's how I did not become a Bernie Madoff client. The fourth area to discuss in this context is staying too long with an unproductive investment advisor or financial advisor. Currently, 58% of Americans maintain a stock market account. Actually, that number is down from 62%, which was the figure of people who had stock market accounts back in 2008 and 2008 during or before the Great Recession of that period. And according to a recent Forbes survey, about 33% of investors, adults and retirees particularly, currently use a financial advisor. So after the Great Recession, where 62% of Americans had accounts, many of those never returned into the stock market, even though there were many good years until now in the intervening years. And currently there are about 54% of Americans who are invested. And 33% of those who are investing use a financial advisor. This percentage seems a little low to me. And I was pondering some of the reasons that might account for that. And one might be the costs involved are a turnoff. The costs involved in working with a financial investor, financial advisor, are a turnoff. Secondly, people don't necessarily trust the market or the financial advisor industry. Trust is a big factor, and you may have seen in the front page of the New York Times this week, there was a huge article about the members of Congress who are being looked into or investigated for some of their stock transactions in terms of the stocks that they bought or sold. And the issue there is that many of these members of the House or senators are on committees that do provide valuable information about what's happening. For example, if you're on the health committee and at a closed meeting, there's a discussion about a particular drug may not may not live up to its reputation and may not pass what they need to do to get approval, then you're in a position to act on that information in terms of what you do about buying, or in this case, selling the stock. So this page one article described how there are 97 cases that are under scrutiny of senators or representatives in the House that have had such transactions that need to be looked into. Another possible reason why people don't have trust is because they don't trust themselves enough in making their financial decisions. So here's a joke. A man buys a new fridge for his house. It's working, it's fine, but he wants a new one. The old one was fine, but he wants a new one. So he takes the old fridge and he puts it out on his front lawn. And he attaches a sign which says, "Good for your home. Fridge in good working condition. Anyone who wants it, just take it, free." And he leaves the fridge and the sign out there, and 3 days pass and nobody comes to look at it. Nobody comes back to look at it. And so nothing happens. He takes the sign away and he replaces it with another sign, "Fridge for sale. old fridge, good working condition, $50. And within a few hours, somebody comes by and sells it. So that tells you something about trust. Here's another example to lighten your day. A very well-to-do investor dies, and he's given the opportunity to visit heaven and hell and decide where he wants to spend his eternity. So he elects first to visit hell, and what he sees in hell are lots of parties, beautiful women, good food, and good wine. And he's very impressed with that. But then he says, I'm going to go and visit heaven. So he visits heaven. And in his visit to heaven, what he sees are little angels strutting harps. So he thinks about it for about a half a second, and he makes a decision. I'm going to hell. So he says, okay, I choose to go to hell. And in a flash, he's standing before the devil. And what he sees in hell are fires, burning fires, and people with pitchforks and screams. And he says to the devil, what's going on here? I thought, what happened to all of the beautiful women and the parties and the good wine and the good food? And the devil scoffs and looks at him and he says, well, sir, I have to tell you, that was the prospectus that we use for selling hell. Okay. So staying too long with an unproductive financial advisor. One of the things that impresses me in this area is how adhesive it can be for people to stay with their FAs, their financial advisors, sometimes for long after they ran into difficulties. I did some anecdotal survey on this with colleagues and friends and relatives. And one colleague of mine said, I stayed with my broker for 25 years and I had no home runs. Gradually, I came to realize that the costs were prohibitive and vastly reduced my profits. Nevertheless, because of my longstanding attachment to him, it took me 5 years to terminate that account. Another person said to me, I had a longstanding but unprofitable relationship with a mainstream FA. I discussed this with my wife and we decided to stay with this person because he gives us advice. So their confidence in their own judgment or decision-making abilities was morphed, was outstripped by the advice that they felt they were getting from their investment financial advisor, even though they were not making much money in those investments. In my own history, this is like part of my shame, I guess. I connected my very first person who became my financial advisor was someone that a colleague had recommended to me. And I contacted this guy and he took me out to lunch and he described what he does. And he was described to me by my colleague as, you will like him, he's knows what he's doing, he doesn't like to lose money, and he's very responsive to you. So I went to lunch with him, he described all of this, and I signed on to open a personal account and a business account with him, okay? So over the years, every once in a while, he would contact me and he would say, Stan, I think you should take a look at considering buying stock XYZ. I said, okay, how come? Why are you recommending that? And he would say, well, I got to tell you, the boys downtown, now this financial advisor was with a mainstream brokerage house in Midtown Manhattan. And the boys downtown referred to the research analysts who were down on Wall Street. So he would say to me, well, the boys downtown are recommending this stock. And I found that so compelling. It was so seductive. Hey, the boys downtown, that was very impressive. And so usually I would follow up with his suggestion and you know, take a position in the stock being recommended by the boys downtown. Well, what happened was I stayed with him for many, many, many years. And he always returned my phone calls. He was accessible, he was available, but nothing, he made a little money for me, but nothing really of any significance. And so at some point when we were talking, and I said to him, I said, you know, there hasn't been much progress in my portfolios. And this is after like a couple of decades of having been with him. And I said, there hasn't been much progress in my portfolios. How, you know, I'm concerned about that. What's going on? What does that mean? And he turned to me and he said, well, Stan, I got to tell you the truth. The average person like yourself or others don't really know more than we do about the stock market. And I said to him, come on, you got to be kidding. And I had placed him on the guru pedestal. He was my guru. He was my investing hero. He was my guru. And I said, you got to be kidding. I don't believe you. And he said, no, it's the truth. The truth is we really don't know that much more than you do about what works and doesn't work in investing. And I didn't believe him. Well, the truth is I didn't believe him because I didn't want to believe him. And the reason I didn't want to believe him is because I needed to have him on my guru pedestal. Over the course of my odyssey in looking for the guru, I had about 10 different financial advisors, all of whom, in one way or another, disappointed me. I didn't stay with all of them for as long as I stayed with the first one, but in one form or another, either because of their inaccessibility or because the fees associated with them didn't work out. I never made much money with any of them. The boys downtown always stays with me as an example of having stayed too long with investment, with a financial advisor. Another example was I went to another financial advisor, and he said he was excessively confident. He was not particularly a good fit. He was very bombastic. He made some bad picks and a couple of good picks. The realization that I came to with him before closing that account was that gurus can also have clay feet. Then I went to someone else who was with a very well-known investing firm, and he had what was called a wrap account. It meant that for a 3% fee annually, we would take care of all of your investments and there would be no charges for any trades or anything like that. And belatedly, it occurred to me that 3% was a significant chunk of my portfolio. And so I discontinued that account. Another disappointing financial advisor, when I closed that account, said to me with some rationalization for his lackluster performance, was that, well, I didn't do better for you because I couldn't reach you when I tried to. So he was not taking any responsibility for his poor performance and kind of projected or externalized it and put it on me. I then went to someone who specialized in no-load mutual funds, and his motto was better safe than sorry, but he significantly underperformed the overall market. I stayed with him for about 7 years, no significant gains in performance, and then I left that. And then I went to someone who I found on CNBC, and I contacted him, and he said yes, he would take me as a client, provided that I paid a 2% management fee as well as the trading expenses. And I did that for a couple of years, which also turned out to be crippling to my portfolio. Well, all of the above led me to take the plunge and to establish a DIY, a do-it-yourself account with minimal trading costs. And I recommend, for, some of you may want or need to stay with a financial advisor, and some of you may feel you might be ready to do a do-it-yourself account. A compromise might be to establish a parallel do-it-yourself account, say and observe that or follow that, the do-it-yourself account in which you make your own decisions as to what you're going to invest in, and compare the results of that account with your brokerage account, let's say for a period of 2 years, and see how that comparison works. What I discovered when I did that, my do-it-yourself account significantly outperformed my brokerage account that I had continued to hold on to. So gurus can have clay feet. As a side note, very often the investment advisors or the research analysts are very late, or sometimes almost never make a sell recommendation. They make lots of buy recommendations, but they don't really make sell recommendations. So for example, Goldman Sachs, which is a very distinguished investment company, not too long ago had recommended a sell position on Netflix. Well, that's fine, except for the fact that at the time that they made that sell recommendation, Netflix was already down 2/3 from its peak. So how good was that? Barron's has a semi-annual, what they call the Barron's Roundtable, of very well-known investment advisors like Abby Joseph Cohen, who make their recommendations. And in the most recent edition of the Barron's Roundtable, I think, which was the beginning of July of this year, they found that all of those advisors who made their recommendations were not very profitable. So this is the noise. This is the noise that happens in stock market investing, and it can be useful not to be swept up in listening too much to the noise. I'm going to move on now to another area which has to do with risk management and cutting your losses. Risk management is a major cornerstone of successful investing. It's extremely valuable to evaluate your level of risk tolerance. Do you have a large appetite for risk, or are you more risk averse? An interesting side note on this point is that studies have consistently shown that women tend to be better investors than men. Women are better investors than men. And some of the reasons that explain that is that women are more patient. Women are, they trade less, they invest less, they tend to research some of their investments a little more, and they invest less money in the stock market than men. And as a result, they tend to be better investors in terms of the percentage of their gains. Everyone wishes to have a winning portfolio, but too little attention is given to how to trim your losses. So many experts are also saying, consider questions like how much can you afford to lose? How much can you afford to lose can be as important as your approach to successful stock picking. Taking greater risk often leads to greater returns is a well-known statement. Taking greater risk often can lead to greater returns, but many investors are likely to resonate to the second half of that statement and to kind of underplay or tune out the first half of that statement about taking greater risk. Driven by the wish for huge returns, the average investor is likely to overestimate his level of risk tolerance. Studies have shown that in general, investors tend to assume a higher level of risk tolerance than their financial circumstances warrant, and thereby they are placing themselves in a dangerous zone if a correction or a bear market ensues. So the caveat here is to stay within your appropriate zone of risk tolerance. Here's a little bit about the history of bear markets. According to Jeff Sommer, who's a writer for the New York Times, he does a column called Strategies, which usually appears in the Sunday business section of the Times. Sommer has noted that since 1926, there have been 15 episodes of at least a 20% decline. That's the definition of a bear market, a 20% decline from the peak of the average in the stock market. The total loss from the peak in a bear market has been almost 35%. If we round that out to about 1/3, that means if you have, let's say, hypothetically, if you have a $3 million portfolio, hey, this is the Hamptons, you may lose $1 million during a bear market. So that's no fun. In an average bear market also, it should be noted that the average duration of decline is usually almost 9 months. That's an average. And the time required to recoup your losses after the bottom is reached is 567 days. Again, that's like about 1.5 years. So if this current bear market is any indication, we're looking into 2023 before there's a significant recovery. One of the other meaningful mantras for success in stock market investing that I write about in Smart Money is cut your losses, cut your losses, cut your losses. You know, in real estate, the mantra is location, location, location. In stock market investing, the mantra is cut your losses, cut your losses, cut your losses. This can be hard to do because you need to tame your ego, which can be susceptible to equating net worth with self-worth. Net worth does not need to be equated with self-worth. But if you don't cut your losses at what for you is a reasonable level to be determined by your individual circumstances and realistic risk tolerance, then you are putting yourself at risk of a small loss morphing into a large loss. Very often when people take see that they have a loss in their stocks or their portfolio, they are reluctant to hit the loss button. They're reluctant to execute a loss because it's only a paper loss until you execute it as a real loss. And so very often people kind of con themselves into thinking, well, you know what, I'm not going to do that. I'm going to, hopefully it's going to recover, and I'm going to wait. Let's say I'll wait until maybe I made a bad choice here, a bad decision. but I'm going to wait until my stock gets back to even so that I can break even. And that, therefore, I don't have to feel the shame or the regret about having made a bad investment decision. And that's something that I've come to coin as something called get evenitis. It's sort of it's a mental bargaining position. It's a way of it's a mental bargaining position of not taking your loss, of not cutting your loss, and staying in hoping to break even. And very often what happens when you don't execute a trade is that your loss that you haven't taken becomes a greater loss. On a more, so that's called get evenitis, and I think it's one of the major examples of what might be the fifth problem, in addition to the big four that I mentioned earlier. One of the, maybe the fifth problem that prompts people to shoot themselves in the foot because it's a major form of self-deception. You're kidding yourself into thinking you can get even when you have a loss, and the loss can morph into a larger loss. On a more positive note, you can be right in your picks less than half the time and still be a big winner. Stephen Cohen, a hedge fund billionaire who is currently the owner of the successful New York Mets baseball team, claims that he is thrilled when his portfolio managers are right 50 to 55% of the time, only 50 to 55% of the time, and yet they make millions and millions of dollars, which means that they sell the rest of the 45% of the time. When they pick a loser, they get out at a very reasonable level and get back into something that becomes more profitable. Because when you hold on and get evenitis, when you hold on hoping to get even, you're also missing, it's also considered dead money because you're also missing the opportunity to move your money into something else that might be more profitable. Early in my own investing career, a consultant, a psychology consultant to me, said to me, you know, there's a very, very new issue that's coming out, and it's something that you really should buy. It's a company that specializes in fertilizers, which then make sweet potatoes as large as cantaloupes. They make sweet potatoes as large as cantaloupes. It's coming out as an IPO for $5 a share. I had a lot of trust and faith in this consultant. He was very intelligent. And so I took a position. I was very young and it was one of my first investments. And I made a small position in that company at about $5 a share. And lo and behold, he was right. It took off. And within 2 years, the stock had gone from 5 to 95. And along the way, they held their annual meeting at a hotel near Grand Central Station, which was near my office. And so I went to attend the annual meeting. And then at the annual meeting, they had on the stage displays of their sweet potatoes, which indeed were as big as cantaloupes. And I took some of them home with me. At any rate, what happened was that the stock gradually began to decline. Something happened to the business model, and from 95, it started to go down and went down and went down. And at some point, I called in to the company and I was told, don't worry, it's going to be good. It's still going to be good. And I didn't know enough, and I didn't want to face the music about the stock going down as much as it was. And it kept going down, and I held it. And eventually it went all the way down. And eventually I sold it out probably at around $8 or $9 a share. I didn't take a loss, but I missed out on the huge profit. So I was not able, and I learned from that experience. and it's very important to learn from your mistakes. And as the philosopher George Santayana once said, those people who are not able to remember history are doomed to repeat it. Those who are not able to remember mistakes are condemned to repeat their mistakes. So I took a message from that experience, and that was very helpful. Let me say a little bit about luck versus skill. Sometimes people are attracted to making buy decisions based on the name of a stock. This is what happened in the dot-com bust in 2000 to 2002. There were so many companies that came out that became IPOs because they had a dot-com name in the name of the company. And many of those stocks imploded and disappeared. Well, let me give you a couple of examples. Back in, I think, 2011 or so, there was a stock that became a IPO, which stands for Initial Public Offering, called Intercept Pharmaceuticals, which was involved in a drug to work against viral liver infections. And, you know, here we are in September, we're in football season, so people might be interested in buying something that has a football type of name. So Intercept is a football term, right? So Intercept Pharmaceuticals came out in 1911 at a price of 15, and it was a home run. It was a home run. People who bought that stock based on the name, what's in a name, right? I talk in my book about what's in a name. And people who bought that stock at 15 got a bonanza. The stock went up momentously. And within a few years, it went all the way from 15 all the way to approaching almost 500. By 2016, that stock had approached almost 500. What a bonanza. And then something happened. And ever since then, gradually, the stock has fizzled. From 500, it went down and down and down. It's still on the NASDAQ. It still trades. It's still in business. But the last time I looked, the low for 2022 was 11. In other words, it had gone from 500 to 11. So what's in a name? You know, if you were lucky enough to buy it and lucky enough to sell it at a reasonable level, that was great. You were lucky, but that wasn't skill. That was luck. Another example would be, I've always been an aficionado of Jaguar cars. One of my favorite cars was a Jaguar XJ6. And so I also noticed that there was a stock one day that was listed among the top 20 gainers in the stock market. It was a little known Brazilian gold mining company called Jaguar Mining. And the stock had gone up like 46%. And one day it was a low price stock. And I didn't buy it, but I decided because I love Jaguars, I'm going to follow this stock. So as I followed it, in the next several months, it had gone up like maybe 40%. And that would have been a bonanza if I had bought that based on the name. Ultimately, that stock plunged and went all the way down to becoming a penny stock. So the turnaround was much greater than the gain. And now, even to bring this up to date, currently, what's in a name? Currently, there's a company called Montauk Renewable Energy. Montauk Renewable Energy. And that's another example of a stock that has done very well since its IPO. It's done very well. And I don't know what's going to happen to it, but I would think a lot of people might be buying that stock based on the name, again, without necessarily researching it or knowing enough about what the company does and the track record, and hopefully to make a gain based on the name Montauk Renewables, luck versus skill. So I think it might be a good idea here to kind of, in the last part of my presentation, to summarize a number of what I like to think of as 10 famous quotes that are sprinkled throughout my book, Smart Money. And these are quotes from famous investors that I think are very relevant and that you might resonate to. Number one, Benjamin Graham, as I told you, the father of value investing. And as I quoted earlier, the investor's chief problem and even his worst enemy is likely to be himself. Number two, Warren Buffett. Be fearful when everyone else seems greedy, and greedy when everyone is fearful. Three, John Templeton, a very famous investor, has a very famous quote. He says, the quote, "This time it's different." That's the quote. This time it's different are the four most expensive words in the English language. In other words, what he's pointing out there is when you're in the midst of a bull market mania and you're thinking this may go on indefinitely, and you're not aware or not thinking about the cycle of bear markets and bull markets, and you're thinking this time it's different, the bull will continue, that can become a very expensive exercise. And likewise on the downside, when you're thinking in the midst of a terrible bear market, this time it's different. It will just keep on going down and down and down and not recognize the cycle element. You may make a difficult investment decision. So this time it's different, according to John Templeton, are the four most expensive words in the English language. 4, Peter Lynch. There's no shame in losing money on a stock. Everybody does it. What is shameful is to hold on to a stock, or worse, to buy more of it when the fundamentals are deteriorating. 5, George Santayana. Those who cannot remember the past are condemned to repeat it, like the cycle of bear markets and bull markets. 6, Ben Graham again. The longer a bull market lasts, the more severely investors will be afflicted with amnesia. Again, the amnesia refers to the awareness of the cycle, and that while you're thinking this time it's different and the bull market will continue, at some point the bubble will burst. It won't continue indefinitely. There will be another bear market. The 7, Warren Buffett again. The greatest enemies of the equity investor are expenses and emotions. 8, Albert Einstein. A foolish faith in authority is the worst enemy of the truth. A foolish faith in authority is the worst enemy of the truth. This is Einstein's this is a plea that financial experts can also be fallible. 9, John Templeton again. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. And 10, John Bogle, the founder of Vanguard. When there is a gap between illusion and reality, it is only a matter of time until reality prevails. So I thank you all for hearing me out on these points coming from my book, Smart Money, a Psychologist's Guide to Overcoming Self-Defeating Patterns in Stock Market Investing.
Thank you so much, Stanley. We really appreciate you being here with us today. If anybody had any last minute questions, feel free to unmute yourself and you can ask Stanley yourself, or if you wanted to put it in the chat, then I can read your question off to him. So I'll wait a minute or two, see if you have any questions. But I wanted to thank you all for being here with us in the meantime. And we did record this, so if you missed anything, if you came in late, if you wanted to revisit the material, we'll send it out to everyone who was signed up at a later time. Everyone for coming, and we hope you have a great weekend. On behalf of the East Hampton Library, we appreciate you being here.
Okay, thank you all. Have a good one. Take care.